Let me know if everybody can hear me. Obviously, if you can't, you can't respond into the text box, but if you can hear me, please type in a yes so that I know that at least the microphone is working. Okay, good. I'm getting that the sound is fine. So today, what we're going to talk about, first of all, for those that are first time on my particular call here on Tuesday mornings, good morning to you or good afternoon, depending on where you're dialing in from in the world, or perhaps even good evening. My name's Dave Floyd. My company is Aspen Trading Group, and I have been in this business for quite some time, since actually 1993. And I've been running Aspen Trading Group since the early 2000s. Mainly in the FX realm, but I do also do stock and option forecasting and analysis, and we will actually talk about one particular setup I'm looking at today in the ETFs via the options market, and we'll get to that. But what I wanted to talk about today is the current state of the markets, and primarily the S&P 500, to a lesser extent the euro. I know the euro was part of the title for today's presentation, but bear in mind I'm coming up with those titles, late last week in anticipation of what I'll talk about on Tuesday. The euro, as I'll show you, is still pretty much a mess, and if you're trying to trade it in here, well, best of luck to you. I mean, maybe if you're day trading it, you might find some setups, but if you're trying to look for swing trades, it's a complete waste of time, in my opinion. But there are some other trades out there. But like everything in the FX market, and I've been talking about this in the previous webinars I've done here at FX Street, FX trading is highly, highly dependent on related asset classes. And if you're new to FX trading and you haven't heard that or figured that out yet, today's the day to really start paying attention to that, because if you're trying to make trades in the FX market while not looking at related asset classes and what they're doing, you're going to be at a big disadvantage. So for me right now, the S&Ps are always important, but right now they're taking on very paramount importance, because I believe that we finally have changed trend in the S&Ps, that we're now in a downtrend overall. I'm going to show you, though, that over the next few days, we're probably in some sort of a sideways trend, but ultimately that trend will resume. In fact, let me actually share my screen while we're sitting here so you can kind of look at what I'm looking at. You should now be able to see my screen, one of my screens, and you'll see an S&P chart. And if you can see my cursor moving around and in the shaded area here, then you are looking at the correct screen. If somebody just wants to type in that that's what they're seeing, that would be great. And I also want to remind everybody, if you have questions along the way, do not hesitate to ask them. I may not answer them in real time, depending on where I am in the presentation. I may get to them at the end. But if it's if it's relevant to what I'm talking about at the time, I will certainly answer it. So don't hesitate to type them in. But if I don't answer it immediately, it's just, I'm not ignoring it. It's just not in the context of what we're discussing right then, and I don't want to get too far off track. So as long as everybody can see my screen, we can start talking about the S&Ps. But before I even get into that, I'm making an assumption here that may be correct, it may not be correct. How many people in here today actually use the S&P 500 as part of their overall analysis for FX trading? I'd be real curious as to how many people look at that. Well, I'm not getting anybody to respond to that question, so Either I've confused you, or you use the S&Ps and just not willing to give it a yes or a no. That's totally fine. But in this market environment, what I would call a risk-off environment overall, if we're expecting lower levels in the S&Ps, which is what I'm expecting, and I'm going to pull up a slightly longer-term chart of the S&Ps here. And I know it's a little cluttered. I'm going to do this. I'm just going to declutter the chart a little bit. Make it look a little bit more presentable. I'm marking the December high as, quote unquote, the high. And what we've had since then is we've had what I believe is 3 waves down off of that high. We had the first wave completed in mid-December. We had a wave 2 completion at the end of 2015. And then we've had a nice 5-wave move down in wave 3 into the January 20th low. Now, this is where it's going to be tricky, and this is where I think a lot of well, actually, let me back up for a second, because a comment came in terms of the S&P 500 here, and I want to back up and address that because it's relevant to what we're talking about. Because if you're not completely clear on why I'm talking about the S&Ps relative to the FX market, it's going to make the rest of today's presentation probably a little less effective, a little less relevant. So I want to jump on that. So let me use a simple example. And the simple example is this. If you're trading the euro, you're probably also looking at the dollar index. Would that be a safe assumption for anybody in here? Meaning you're using the dollar index as kind of your proxy, meaning that if you're a stock trader and you're trading, let's say, Apple Computer, or some other high flyer, be it Google or whatever, you're very likely watching the S&P 500 or the NASDAQ as your barometer for whether or not you should be short or long the individual stock that you're trading. Would everybody agree to that premise if you're doing stock trading? And again, I would ask that you kind of get engaged here so that we can all be on the same page, and that'll make it far more effective for everybody here on the call. Okay, so let's use that same logic. The S&P 500, obviously, very widely followed, very broad-based asset class that is, relevant to traders worldwide. If you think about it, the S&P 500 is a good gauge of risk and risk off. And what I mean by that is people are either willing to take risk in the capital markets via the S&P 500 or equities within the S&P 500, or they're not willing to, meaning that they're pulling back and they're taking money off the table, which I would call risk off. So it's either a risk on market or a risk off, and that's a very simplistic way to look at the market. Obviously, it's more complex than that, but let's just think of it in that way. When the S&Ps are going down, it's a broad assumption, and again, for our conversation today, it works just fine. I would say we're in a risk-off market. People are pulling money from the table and less likely to put risk capital on the table. Well, when that happens, currency pairs like the New Zealand dollar and the Australian dollar, and of course emerging market pairs, but I don't really trade those, so I'm not going to go into that. Those pairs tend to also be very sensitive to movements in the S&P 500. I'll give you a good example. Let's see if I can pull up a chart here. So here's the S&P 500. There's no lines or no labels or anything. It's just simply a candlestick chart from the highs in December through where we are currently. Well, let me do something on here and I'll illustrate my point quite clearly. So what I'm going to do is I'm going to overlay the Kiwi dollar on top of the S&P, and I'm also going to overlay the Aussie dollar. And if anybody on the call is kind of wondering why I'm going to all this level of detail and why I'm doing this and kind of shaking their head going, geez, what a waste of time. Why don't I just look for the chart pattern and make a trade? I get that desire to want to just simply dive in and move forward. I can assure you over a period of time, that is going to be a very flawed and very limiting strategy. My thought as a trader in my 20 plus years in the business, be it as an equity and an FX trader, has always been the quality of the trade, not the quantity. Far too many traders get hung up on wanting to be in the market all the time, get that rush, do all that other nonsense, as opposed to being patient, putting together a thoughtful and comprehensive piece of analysis, and then making a trade. If you're not looking at other related asset classes, you might as well just be tying one hand behind your back and allowing someone to take money out of your trading account on a routine basis. So what you can probably see quite clearly in here, at least that's my hope. See if I can get this down to a 6-hour time frame, because I want to show something a little bit more close to what we're going at here. This is perfect. We're looking at a 6-hour chart here. Again, the candlesticks are the S&P 500. The blue line is the Aussie dollar. The green line is the Kiwi dollar. And you'll notice that the minute the market started to move lower, what did these two currency pairs do? They immediately traded lower, almost tick for tick, with the S&P 500. Therefore, going forward, if you want to be trading the Aussie dollar or the Kiwi dollar, you better well know, or you better make sure you know what the S&Ps are doing. So if you're looking to get short the Aussie dollar here, let's just say you're wanting to do that, which I happen to be looking to do, but the S&Ps are suggesting a bullish move, let's say towards 2100. I'm just thinking hypothetically here. That trade won't work out. I can almost assure you of that. If the S&Ps are going to rip higher, so is the Aussie dollar and so is the Kiwi dollar. So if we take a step back and go back just to the S&P, well, first of all, let's go back for 1 second. If you're in agreement based on my premise, my hypothesis that the S&P 500 is a driver of the Kiwi dollar and the Aussie dollar, great. Then let's go back to the S&Ps where we are right now. Trend is clearly down. We've had a rally off the January 20th high. I don't think this correction's complete yet. And there's a couple of different ways we can look at it. For right now, I'm thinking that it's probably going to be some sort of a sideways triangle type correction. And that could go on for, a few more days. I also think that if we can get above this swing high right here, the January 24th swing high at 1904, call it 1905, then I think we're probably going to have more of a traditional correction. And I'll show you what I mean by that. We're probably going to have a correction that looks something like this. And I'm just drawing this in here to illustrate. Oops. So we'll probably have a correction that looks something like this. We'll probably trade up towards the 1950 level, maybe even 2009. I don't know. But again, very simple, very objective-based rules here. Above 1905, we're probably going to go higher on the S&Ps. In the meantime, if the other forecast is correct, both of which are bearish, by the way, one just allows for prices to move higher before they ultimately move lower. The one that I'm looking at currently just allows for sideways consolidation before they move lower. Under either scenario, trying to short Aussie dollar or Kiwi dollar may be okay if you do it now and we get sideways correction. You just may not get that immediate gratification that all traders love and crave. But if you are to get short Kiwi dollar right here or Aussie dollar, you better prepare for it to move higher if in fact the S&P still have one more leg higher in this correction. And that's the big mistake a lot of traders make. They get in and they don't consider what the different scenarios are. So if you're looking at the S&P 500 as your gauge and you're saying, well, you know what? I'm pretty sure this is going to be a triangle and I don't want to take the chance of missing out on a break lower in the Kiwi dollar and or the S&P 500. I'm going to get short in here. You better get short knowing that prices could rally against you a little bit. So either you get stopped out and reevaluate, or you factor in a stop loss that allows for prices to move higher. Yes, it's going to result in a drawdown temporarily, but ultimately, if your analysis is correct, that money will come back to you because prices will reverse. Does that make sense? I want to make sure everybody's on the same page here because I'm throwing a lot of information at you, and I don't mean this because I'm saying it, but this is important information. And if you're not understanding it, I want to make sure you do, because if not, the rest of today's presentation is just going to kind of fall on deaf ears. All right, looks as though question in here, New Zealand, you mean you're talking about the New Zealand Australian cross is negative correlation? Well, we're not going to focus on that particular cross at this point. We're just keeping the conversation related to the S&P 500 and the impact on the Aussie US dollar and the Kiwi US dollar. I'm not going to go into the Aussie Kiwi cross because that's a different kettle of fish altogether. Let's just, again, like most things in life, trading really ultimately boils down to very simple things. And if we keep it simple, you'll find that you'll be far more effective. No, it's positive correlation between the Aussie dollar and the S&P 500. Negative correlation means they move in opposite ways, meaning if the S&P 500 were to rally and the Aussie dollar sells off, that's negative correlation. But if the S&P 500 falls away, like I'm showing here in this chart, and both the Aussie and Kiwi dollar fall away in tandem, that's positive correlation. Just because prices are moving down doesn't mean it's negative correlation. Correlation is, do things move in tandem or do they move opposite of one another? So if they're moving in tandem, it's positive correlation. Moving opposite one another, that's negative correlation, but they're still moving in a one-to-one relationship, basically. Does that make sense? So this right here is negative. I'm sorry. This right here is positive correlation. Okay, perfect. So back to our analysis. So if we are in agreement, which we are, that as the S&Ps track lower, so will Aussie and Kiwi. The wild card for me right now let's kind of bring this into real time. What do I do right now if I'm forecasting lower levels in the S&P 500? The answer for me right now is I'm kind of waiting, because I know I've got two possible scenarios here. If we stay below 1905, I'm guessing we're just going to sideways chop and then ultimately break lower. Now, if I want to get short because I think this is going to be the pattern that plays out, that's fine. I have two decisions to make. Do I have my stop loss above this 1905 level? Or do I allow for prices to move higher and stay in the trade and then maybe add to it up here? That's a personal decision. There's no wrong or right answer. The important point I'm trying to make here is that in corrections, they're really difficult to always figure out because they can unfold in very, very, in a variety of ways. So what I think is important is if you are getting short Kiwi and or Aussie dollar in here, expecting another break lower in the market and hence a break lower in those pairs, just know that the possibility exists that prices could rally a little bit more. Maybe you cut your losses and then get back in at a later time, or maybe you just factor in that prices could rally a little bit more and then maybe you add to them as they rise. That's the important point I want to make here. So if we have, and again, I'm being pretty broad, but I'm also being very specific at the same time. But broadly speaking, that's how I see the S&Ps. How I ultimately decide to execute the trade, we're going to get to those in the days and weeks to come as I do more and more of these weekly webinars here. But if we understand that general premise, and that's our thesis going forward, the question is which one do we want to tackle? Do we want to be short Aussie dollar? Do we want to be short Kiwi dollar? And then it's really just a function of looking at the individual pairs and figuring out which one probably makes the most sense. And let's do this. I got to get my waves back in here. So I'm going to do this. Now, to me, if I had to make a choice between the Aussie and or the Kiwi to be short, and let me just go back to a 4-hour chart here, I'm probably going to choose the Kiwi dollar because it is the one that has rallied the least while the S&Ps have rallied. Because let's look at this. Here's the S&Ps on a 4-hour chart. They're pretty close to taking out the recent high at 1905, or I'm just calling it 1905. Kiwi dollar is still a good 56, still a good 70 pips away from taking out that high. It doesn't mean that prices won't move higher, but what I'm saying is that the Kiwi dollar relative to the S&Ps right now is lagging. It is correlated, but it's not as correlated as, let's say, the Aussie dollar, which is moving more in tandem with the S&Ps right now. So if we use that logic, when the S&Ps start to sell off again, if and when they do, and I do believe they will, my logic says the Kiwi dollar is probably more likely to move lower faster in tandem with the S&Ps because as of right now, it's lagging it on the rally. So I'm making an assumption. If it's weak while the S&Ps are rallying, it should be really weak when the S&Ps are selling off. Does that make sense? And again, I need you to understand that. So just type in a yes or a no, and then we can move on. But that's an important distinction to make because it helps you decide which is going to be the pair that should be the most robust to be short. It doesn't mean that Aussie dollar won't move lower also, but where are you going to get the most bang for your buck? Okay, so I got one person in here that's not following. Can you explain, pardon me, briefly, what was it that you were not understanding there? And again, it's totally fine to ask questions. That's how we all learn. And I'm happy to address the questions because if you don't understand this, the rest of the presentation, and quite frankly, your trading will suffer because of it, because these are concepts that I think are pretty much universal. You know, there's no proprietary information here. I'm just talking basic market correlations and how markets move together. Okay, again, we're just going to keep, the question was, this person, I don't know if it's a female or male, they're not understanding which one is the better short, Aussie dollar or Kiwi dollar. Let me show you a simple chart here that I think will help quite a bit. And I'm going to do this. Just bear with me while I build this out. you know what? Yeah, let me do one thing here. Okay. What I'm doing here, I've got the, remember, we're keeping this very simple here. We're looking at the S&P 500, and then we're only looking at two currency pairs, Aussie and Kiwi dollar. If we take the recent rally in the S&P 500, and I'm going to measure from that low, because as I said, I'm looking for a correction higher in the S&P 500, and I want to find out when that correction stalls out and the trend lower resumes, which pair is going to be more than likely the better one to be short. I think Aussie and Kiwi will both go down. That's just how those trade. We've already discussed that in terms of the correlation. Now the question becomes, which one's likely to perhaps be the weaker of the two? Now, there's no way to know definitively which one will be, but here's an assumption, and here's a way to kind of look into that. So if we take the recent low in the S&P 500 and we use that as our starting point. Oops. And I'm going to go to a 15-minute time frame. So off of that recent low, meaning the low from this morning, the S&Ps have rallied about 1.7%. Aussie dollars rallied 0.88. Kiwi dollars only rallied 0.65. Again, this is an assumption. This is not a fact. But all other things being equal, if Kiwi dollars not keeping pace, and again, nor is the Australian dollar, if they're not keeping pace with the rally in the S&P, don't you think it's a safe assumption that when the S&Ps actually start to sell off, these would in fact be weaker, especially the Kiwi dollar? It's the argument basically is, let's look at it from a stocks perspective. If the S&Ps are rallying and Apple's not keeping pace, when the S&Ps roll over, Apple should really actually be the weaker at that point in time. It's the same argument. Does that make sense? Is that a better way to look at it? And again, I know this might come across as complex, but I have some bad news. Trading, at least when you're first getting into it and when you're trying to become really proficient at it, there are a lot of moving pieces. It does become easier with time. It becomes second nature. But anybody who's proposing that you just follow a 1, 2, 3 step and you're going to be a good trader, they're blowing smoke. The reality is this is what you have to go through on a trade-by-trade basis to put the odds in your favor on a consistent basis. If you don't do this, you're flipping a coin, and that's the brutal truth. Don't get discouraged by having to do a few steps. You wouldn't do that in any other profession. There's certain steps you take in order to do the project at hand, and if it's complex, you know that's just the way it has to be. So anyways, I need to understand, or I need to know, is this clear to everybody in here? So if I'm looking to get short Aussie or Kiwi at this point, when and if the S&Ps move lower, my bet is the Kiwi dollar. Then we can take it a step even further, and I'm not going to go into that today because I've thrown so much information at you. Then I'm going to start looking at the chart pattern of the Kiwi dollar. Where is the good entry point? Where is the level that would represent an ideal entry point? No, Aussie is not the better short. No, Kiwi dollar is the better short because Kiwi dollar has not rallied as much as the S&Ps, and it's rallied even less than the Aussie dollar. Now again, both of these currency pairs will move lower if the S&Ps are moving lower. That's not the topic at hand. The question at hand is which of those two is likely to be the better one. Now if we go back and we just look at the Aussie dollar over the last couple of days, the Aussie dollar's made a nice move off of the low. So kind of burn that image into your brain. Now let's look at the New Zealand dollar. It's made a move off the low, but not to the same extent. Again, it's lagging the market is how I would describe that. Now my forecast is still that prices are still likely to rally a little bit more, probably up towards 65.5, 66 in the Kiwi dollar. And I think that'll mark the end of the correction. And if that's the case, that probably suggests that the S&Ps move a little bit higher from here as well. That's not the question at hand. The question at hand is which of the two are going to be the better ones to be short? I would say the Kiwi dollar. The next phase is when do we get short? Do we allow for prices to move higher? Where do we set our stop loss? That's a whole other set of questions. Right now, all I'm interested in right now is the S&P 500. Until I know where the S&P 500 are going, I'm not going to be making any trades in the Kiwi dollar or the Aussie dollar. Now, I do have some clients that are of the opinion, and I get emails from them all the time. I'm going to go back to the S&P 500 here. Just bear with me. Their opinion is that this is the correct count. A, B, and then we're going to run up towards the 1940 level. Therefore, they're long the Aussie dollar in here, and they're willing to take a shorter term trade because they know as the S&Ps move higher, Aussie dollar is going to move higher. That's fine. That's one way to approach trading. I personally would rather wait to get short because that's the dominant trend in the market right now. I don't like trading within the context of a correction because in a correction, prices don't move as fluidly. You don't get the same type of range expansion. So I'm personally happy to sit tight until I get a good handle on when the S&Ps have stalled out and what I believe are on the verge of moving lower. That's when I'm going to look to get short the Kiwi dollar. I could be long the Kiwi dollar in here, but I think what we've already determined is, one, we don't know if the S&Ps are going to continue to rally. And number two, we already know the Kiwi dollar is lagging the S&Ps on this move up. So why would I really want to get long the Kiwi dollar when you've got a couple of things already working against you? I would rather wait to get short it because then I'm aligning myself with the dominant trend. Does that make sense? And I'm waiting. Either everybody's eyes are glazed over and completely confused, or everybody's clear on the logic that I've laid out here. And I hope it's the latter. And I hope I haven't scared anybody away by being long-winded and providing a lot of different parameters for trade selection. But it's my belief. I mean, I've been in this business for 20 plus years. this is the way you come up with trades. There are no shortcuts. I mean, for me, it's a shortcut because I know how to do this. I've been doing it for a long time. But these are the steps, in my opinion, that that you really need to take in order to find effective trades. And if I might say, it's one of the reasons that I'm probably one of the only guys out there who actually manages money based on what I do and have it on my website as public record. Don't see a lot of people doing that. Because I think at the end of the day, it's really easy to come in and throw a lot of stuff up on the screen and go, I bought it here, I sold it here, and this indicator's flipping over. I don't know. I'm not so sure. Trading's a little bit more nuanced than that. So if we take that same logic of the S&P 500, or let's just say the market in general, I'm also rather bearish on the Russell 2000. Basically, it's a very similar scenario. If the Russell 2000 is going to move lower, I'd like to be short the Russell 2000, and I can do that by being short IWM, which is the ETF for the Russell 2000. And again, this is in sync with what I think is happening in the overall market. So I could, if I'm correct on the S&P, if I'm correct on the Russell 2000, I can be short the Kiwi dollar. I can be short the Russell 2000. In my trades, my two trades are in harmony with one another. I'm not requiring the markets to do different things in order to make money. Now, what I've decided to do with the Russell 2000, and we can talk about this in next week's presentations, we don't have enough time for today, is an option strategy. I happen to be long a bear put spread, and I started building that position yesterday. And since I believe it's possible that we could still rally a little bit more, I might continue to add to that. But I'm fully aware that my entry in here yesterday, and I'm only about break even on the bear put spread at this point in time, I'm fully aware that prices could rally a little bit more, but I factored that in before I get into the trade. I didn't go in drawing a hard line in the sand saying this is the top and now the Russell's going to roll over. I'm fully aware that prices could rally a little bit more. And if they do, it's within my risk tolerance, and I've even left enough wiggle room for me to add to the position if I so choose. So I guess to kind of sum up, broadly speaking, I'm looking for the S&Ps to move lower. If the S&Ps move lower, Aussie dollar and Kiwi dollar are very good candidates to be short in the FX market. By going through the steps that I showed you today, my personal choice would be to be short the Kiwi dollar. When I get short, where I get short remains the wild card, because we don't know when the S&Ps are going to break lower, unless, of course, you're going to give yourself a wide stop and be very patient. And if you're going to do that, that's okay, because I do believe the trend is down. And I think in the next few days that ultimately will resume. But if you're trying to be a little bit more precise in your entry, I think it's too early to be looking to get short the Kiwi dollar. So with that said, I'm going to turn it over to Q&A, but I've had very few questions today, so I'm not sure if I'm going to get any other questions, because I don't know if either everybody on the call generally understood what I was talking about or I confused the heck out of people. I hope it's not the latter. But why don't we get in some last minute questions, and I'm more than happy to address them, and then we will be back again next Tuesday at the same time, and we'll kind of see where these situations played out. So I'll give you folks a minute or two to type in your questions, and I'll be right back.